Oofed. The Australian federal budget was handed down this week and it has caused quite a stir. In fact, for the whole time I've been an accountant, I can't actually remember the last time I've seen so much noise and people talking about a federal budget. Look, I won't lie, not that pretty for business owners and investors. So, I ran a webinar for my clients where we covered the main areas of the budget, the areas that affect business owners most, and that's what I'm sharing with you today. Now, before we dive into it, just keep in mind, this information is based on what we have at the moment. There are still a lot of missing pieces, so some assumptions, scenarios will change as we get more info. On that note, let's dive in. Team, hello. For those watching the playback, we're going to run through the budget today, and we're going to run through the things which were announced, the main things affecting business owners, and we'll talk about each one, how it's currently looking. We just have to be mindful that a lot of details haven't been released. There are certain large changes that haven't been legislated yet, so more will come. And there's a lot of fear mongering out there. So if you're seeing on social media that where everyone's going to be paying 47% tax, that's not the case. I also want to be here to give everyone peace of mind as well. I'm not saying it's good, okay? Political stuff aside, that was a rough budget, especially for business owners. I'll kick it off by sharing my initial thoughts, but I'm just going to have a quick look at the chat. I'm ready to stop paying tax, aren't we all? It's not going to be easy under Albanese. That was a promise. Is that the first political promise ever to be kept? Uncertain, yeah. That seems to be the temperature of the room. Agreed. Needs significant revision. So my thoughts here is this. I can understand how they arrived to wanting to make some change, right? Like a lot of Gen Zers, younger people are feeling quite dejected, very unmotivated because they feel like the playing field isn't level. Comparing it to when our parents, I'm a millennial, 39, our parents were in Australia and you could buy a house for a bag of popcorn and half a Sharpie. I get it. So they're trying to level the playing field and solve this housing problem for people. However, with what was announced, that got me confused because a lot of the changes also affect business owners. Now, I can also understand people wanting to extract a bit more tax from very high net wealth individuals, like your Gina Reinhardts of this world and the large corporates. But my whole client base is all business owners, small to medium business owners. And the ironic thing is the ones who will be most negatively impacted are those smaller business owners, the ones who want to create wealth. It's almost like if you don't have a whole lot and you're not in business, this budget doesn't really affect you that much negatively. And you might be like, yeah, go budget. If you're super high net wealth and you already have your wealth, this budget might not also affect you a whole lot. It's that chunk in the middle who are wanting to build wealth. The young business owners out there who want to are trying to get ahead. They're learning the rules of the game and they're working very hard, sacrificing time and energy to build wealth. They're the ones who are actually being affected here. So let's actually run through each of the main talking points and I'll share my thoughts on those and we'll dive a bit more into detail with what it could look like potentially and what a few solutions could be. Okay. And really helping you all understand the changes. Now, once again, I just want to stress a lot of this isn't legislation yet. And the proposed times where they're going to be rolled out a lot of them are going to be in like July 2027 or afterwards. So we have time. Now, for those watching live, please make sure drop comments. The more you interact with me, the more I give, the more I kind of feed off of that. Please post questions. I have the ability to bring people on the call. If you're not camera shy, if you are, just post a question and I'll do my best to answer it. Okay. So if I'm saying, hey, give me a bit of feedback, is this making sense? Drop emoji, drop a peace sign, drop a poo emoji. That's all good. Now, let's dive into it. I've got a few notes here. I will share my screen Now, I just do want to give a shout out. A lot of my notes do come from Advisors Digest, the team at Advisors Digest. They do an amazing job at providing us with the budget dot points that makes a lot easier for people to digest. So, at a very high level, let's share this. The federal budget at a glance. Drop an emoji if you can all see that. Amazing. Okay, so at a very, very high level, what we want to look at here is this is broken down into the various different areas that the budget touched on and what they mean for everyone. So let me just move that one there. Okay, the very first one, a lot of these I'll just breeze through because they don't really impact too many business owners. But the first one is the personal tax. So what things impact individuals? The first one is the $1,000 instant tax deduction. Now, what is that? So you might see on your individual tax returns that people oftentimes claim anywhere up to $300 as other work-related expenses. And oftentimes you might hear from your accountant, oh, look, you might not need receipts for them, but you just have to loosely justify what that $300 was for. Well, that is moving up to $1,000 now. Okay, so basically the government's like, hey, we know everyone's claiming tax deductions. How about let's let you claim a flat $1,000? No receipts needed. It's optional, and you can only claim this against income from a salary and wage. It's a work-related expense, meaning if you just receive a dividend or just receive a trust distribution, this cannot be claimed. So the first thing that comes to my head is potentially looking at ensuring, no matter what your structure, that you do pay a salary and wage from your business. It doesn't have to be a large one, but that you do pay some sort of salary and wage from your business to you. This kicks in 1 July 2026, so essentially for next financial year. Next one is the Medicare levy threshold. That's just going to be a applied thing, so we won't necessarily need to go into that too much. The next one is the $250 Working Australians tax offset team. So it's a permanent $250 tax offset for wages, salaries, sole trader income. Basically, it reduces the tax bill by $250 from the 2027 and 2028 year. That's very generous of the government. I can see a few thumbs up there. I don't know if they were thumbs up of irony, but yes, huge win. Makes everything else okay for business owners. All the other take, that this makes it all right. Insert sarcasm there. So look, for individuals, yes, the $1,000 instant tax deduction, great. The $250 Working Australians tax offset. If you're paying yourself a wage, you're going to be able to claim $1,000, get the $250, happy days. Stop now that we are ahead. Great. Yeah, webinar's over, right? We're ahead. Let's call it a night. So that's for individuals. I'll move to property and negative gearing next before we go to the stuff which affects business owners a bit more. So from a property and negative gearing point of view, we've all heard negative gearing has been restricted. So from 1 July 2027, existing investment properties are fully protected. Newly established properties bought after budget night, losses can only offset rental income from 1 July 2027 onwards. All right, so I think it's pretty self-explanatory. Basically, if you already have a negatively geared property before budget night, happy days. If you're going to purchase another property in the future that does not increase the housing supply and is not a new build, then you may just want to factor into your calculations that is a property still affordable even if you don't receive any negative gearing tax benefits. Now, my view is that when you're looking at purchasing an investment property, I personally want it to be affordable irrespective of negative gearing, right? So negative gearing should be a bonus, not the reason why the property is affordable, okay? I know not everyone does that, and Yeah, I think just good financial hygiene, make sure the property is affordable without negative gearing anyway. This is just pushing people into that situation. One interesting thing with the negative gearing is this. When business owners ask me, hey, where can I buy a property? Like what structure type? Previously, I always say, hey, because you're a business owner and you've got companies, you've got trusts, you can you've got flexibility on where you buy the property because as long as you've got a way of getting income into the structure, then you can take advantage of negative gearing, right? For individuals who don't have businesses, I've always been very hesitant to recommend structures for them to buy properties in. The reason is because if the property is negatively geared and they buy in a structure for whether it's estate planning, wills and estates, whether it's protection purposes or long-term tax planning, they don't have a way of getting income into that structure to take advantage of the negative gearing. You can't put your salary and wage into a trust. You can't put your salary and wage into a company. Since negative gearing is basically being phased out for a lot of properties, in a way that is a feather in the cap for individuals to purchase properties in a structure because now they don't really have the downside of losing out on negative gearing personally since they weren't going to get it anyway. So if we had to see a silver lining, all that really looks like is their existing options got worse. So the second best option now looks better. And for those of you, if you're a bit lost there, I'm happy to draw that out. So if anyone's needing, hey, can you draw this out on a diagram? I'm happy to do that too. Okay, so make sure you post into the chat there. New builds remain fully exempt. We have had some smarty pants who ask, well, Andy, if I knock down my house, my main residence, and build, can I then claim negative gearing if I rent it out? Unfortunately, no. It has to increase our housing supply. I saw a few laughing emojis there. I know people were thinking it. Unfortunately, yes, that is something which has been considered. It does have to increase the housing supply. And the foreign buyer ban extended. Superannuation, I think these have been announced before, especially around the 30% balances on over 3 mil, so we won't necessarily go into that too much. The one thing which we have sent out, I think everyone's heard about this, is as of 1 July 2026, so in a month and a half time, payday super begins. In a nutshell, when you pay your wages, you pay super. Okay? There's a few more nuances than that, but we've always been advising our clients, hey, just pay your wages when you pay super anyway. The main reason is, for those of you who may not know, is if your superannuation is paid late, it's not tax deductible, which kind of sucks because it can be a significant dollar amount, right? So even if you pay it a day late, it's not tax deductible, and it's not based on when you pay it out of your bank account. It's based on when it goes to the fund. So if you transfer it on the day it's due, it will be late, which is why we always say to people, hey, pay your super when you pay your wages. Sure, it's right now it's not technically due until every quarter, the 28th day after the end of the quarter. It's not worth it being late. All right. And if it's late, you've got to lodge something called a super guarantee charge statement, which is basically self-dobbing in on yourself with ATO, which says, hey, my super's late, charge me interest, charge me a filing fee. Not a fun time for anyone. So just pay it when you pay wages. Now, businesses, there were a few gifts to businesses. I don't think anywhere near it doesn't anywhere near outweigh the downsides, but these are welcome. Number one, look, the $20,000 instant asset write-off, they extend this year on year on year. So the fact that this is permanent now, I'm not surprised. Happy days. All it means is you don't have to guess, hey, is it going to be around during budget time as you're investing back in the business by purchasing assets? So that's 20 grand per asset. It has to be in place, ready to use by 30 June if you want to claim it in that financial year. Now it's permanent. This was an interesting one. I wasn't expecting this, was the company loss carryback. So for those of you who had a business around the COVID time, excuse me, There was a loss carryback provision. So basically, which means if you made a loss in the current year and you had paid taxes in the prior few years, you could carry back that loss and basically get some of your tax refunded out to you. Okay, to kind of help cash flow, kind of help a situation where there's a downturn in the economy for whatever reason. Back then it was COVID, and you could claim you had a loss this year, but you had big taxes from the year before. You could ease cash flow a bit. It sounds like they are bringing that back in as of 1 July 2026. So from next financial year onwards. So it doesn't really impact this year, but if next year you're looking to make, well, not that you're looking to make a loss as a business owner, but if you are in a loss position, that could be a powerful tax planning strategy to actually help ease cash flow. Startup loss refundability. Startup companies can convert losses to cash refunds from the ATO, which is an interesting one. This is from 1 July 2028. I would be curious to see how long this lasts because and what the details look like for startup companies, because I can see that getting out of hand, but let's see what people make of that. And the R&D tax incentive reformed, okay, which doesn't affect too many people here. This is one of those very niche items where anytime R&D is involved, we always recommend a specialist be involved in putting together the R&D applications, because there has been situations in the past where the ATO have approved R&D tax offsets applications, and then they've come back and basically say, hey, we want to review those things that have been approved. There was a situation, I think about 9 years back now, involving a Big Four accounting firm where a lot of their R&D clients had a situation where previously approved applications were reviewed, and that wasn't a pretty situation for many people. Before we get into trust, we'll look at the other ones, which is number 1, fuel excise cut ends, so 32 cents per litre, reduction expires. It doesn't affect a lot of clinic owners or anything like that there. This one, interesting, the EV FBT exemption wind back begins. So as of 1 April 2027, which is next year, the threshold comes down to $75,000. So just to break that down, and this is something which a lot of people don't realize. If you have a business in a company or a trust and you buy a motor vehicle, that is not your motor vehicle. It belongs to the company or trust. So if it's available for you to use privately, technically the business is providing you with a fringe benefit. In layman's terms, that is bad. It costs you money to use the car privately because it's owned by the business. There are exemptions to that. One of them is an electric vehicle. So currently, off the top of my head, it's around the 90 grand mark. If the electric vehicle, full EV, not a hybrid, full EV is purchased and it never had luxury car tax paid on it, which is that 90 grand mark, then it would be exempt from fringe benefits tax, right? So basically, you can have a car in the business, claim the tax deductions without worrying about you having to pay fringe benefits tax on any private use. So as of next year, they're going to move that down from 90 down to 75. So what does that mean for you? Look, if you have been eyeing off a EV and it is going to be more than 75K, then you've got until end of March next year to do that. And as of 1 April 2029, all EVs below the luxury car tax threshold receive a 25% FBT discount. So what that tells me is from 1 April 27, they're reducing the threshold for the EVs that will be eligible for the exemption. And they're going to keep reducing that threshold potentially until April 2029, at which case future EVs won't receive an exemption. They would just get a 25% fringe benefits discount, which I would be curious to see when we do some cost benefit analysis on whether it's still worth buying the cars in the business. Because as a general rule of thumb, I don't like cars in businesses unless you can manage a very, very high logbook that shows you use the car 80-90% for business use, or it's an EV that's eligible for the FBT exemption, or it's something like a ute or a trades vehicle, commercial vehicle. Okay. That's all the other stuff. Like I said, we breezed through the other stuff. Let's get into some of the more juicy things. We do have a question. Will cars brought before that date yes, based on what we've seen so far, yes. Will they, does that mean it's definitely locked in? I can't promise that. But based on what we've seen so far, yes, it seems that way. Now, the biggest changes. Number 1, capital gains tax. From 1 July 2027, the 50% capital gains discount is replaced. So, what does that mean? Right now, as if you have an asset, so something of value, and you hold it for more than 12 months, you get a 50% capital gains discount. I'll give you an example. If you buy shares on the stock market for $100,000 and you sell it for $200,000 a year later, so you've held it for more than 12 months, you make a $100,000 gain. 50% of that gain is tax-free under the current laws. So you only pay tax on $50,000. Okay. Same thing goes for property. Same thing goes for many other assets. Businesses as well is technically an asset. So if you start a business and it costs you zero, your cost base is zero, you didn't pay anything to start the business, and you sold it for $1 million, you would get 50% tax-free, which is $500,000. Okay. Just to clarify, companies never got this 50% discount. So this was only for trusts if the profit made its way to an individual. All right. That is going away as of 1 July 2027 and is going to be replaced by an indexation method. Essentially, it's going to be indexed by CPI. So apparently there was a system back in the day, before my time, from 1985 to 1999, where indexation was applied for assets held for more than 12 months. It sounds like they're going back to something like that. So what does that actually look like in practice? Well, if you're in a situation where you have a very low inflation environment, meaning CPI or indexation is low, and you make a big gain, you are way worse off under the new scheme than the 50% discount. Because if, let's just say you made, someone out there got really lucky in crypto, which has happened, right? And they've made $100,000 in crypto in 12 to 18 months. Inflation's going to be bugger all, right? Unless you're in a hyperinflation environment, inflation in that 12 months to 18 months, 3%, 4% maybe. So under the new rules, if you made $100,000 as a gain in crypto and inflation is 3 to 4%, then your cost base creeps up by 3 to 4% and you pay tax on the difference between your cost base plus 3 to 4% and your ending sale price. Doesn't sound great. Compared to the current situation where if your cost base is, say, 100 grand, you make 100 grand on crypto, half of it's tax-free, so you only pay tax on 50 grand. So that's quite a large difference. Now, it's not all bad though, because there are situations where if you've held something for a really long time and it hasn't actually gone up a whole lot. So let's just say you held something for 10 years and it's only gone up $100,000, all right? And in that 10 years, there was a lot of high inflation. It was a very high inflation period throughout the 10 years. Then technically, there is a chance that indexation on the cost base, so the cost base being inflated every year for those 10 years, could actually have you resulting in a lesser gain than compared to the 50% discount. Very niche example, but we have to point out both sides there. So there are scenarios where this is better, but yeah, I think I am clutching at straws there. It's not going to be a lot of cases there. All right. Now, I can see how this was implemented for properties to make properties a less appealing investment. I highly disagree with this when it comes to business owners because, and once again, we don't have all the details yet, but the shares in your business, just say you trade out of a company and you hold shares, those shares are an asset which would have potentially been eligible for the 50% discount before. And for most business owners, the cost base of those shares when you set up a company, they're worth $1. Now, you can index $1, inflate $1 by 100%. It's still not a whole lot, right? So for a lot of business owners, it means if you sell your shares, potentially that whole gain is taxed because indexation isn't going to make that much difference. The other one is goodwill. Like if you start a business, let's just say we're in 1 July 2027, I started a business, set up a company, and we just started the business. Cost is kind of zero. Yeah, I have company setup costs, but I claim those as a startup cost. So it doesn't form part of the cost base. My setup is zero. All the things the laptop I buy to do the business, I'm claiming that. So my cost is zero. And what happens if you index zero? If you increase zero by 1,000,000%, it's still zero. Now, they may implement some details and nuances which will change that, but the way it's currently written, that's how it reads. Not a fun time for businesses. What does this mean for existing business owners? Well, let's look at this. So we've got, can everyone see the Excel spreadsheet there? Or Excel page there? Yep. So if we have, this is us today, we've got, today, all right, I can't spell today. and we've got 1 July 27. All right. So between now and then, the 50% discount applies. At this point is when indexation is going to start kicking in. One of the big questions from people is like, hey, does that mean if I already have the asset, does that mean that I'm going to have to sell it before this point here, 1 July 2027, because then I'm going to lose out on all of this 50% discount? No, that's not how it'll work. So they have been gracious enough, our overlords, to basically say if you currently hold the asset, gains from this date, the 1 July 2027 date, will be indexed. Which means we will still be eligible for the 50% discount if we were originally eligible for it on gains up until that point. Now, you might be thinking, Andy, what if we haven't sold the business at that point? How would we know? So this is where there will or may be an option or in the tax return at this point for the 30 June 2027 tax return to report the value of the asset. Now, I believe the ATO will have or do have their own calculator that you could potentially use. I would be very hesitant to go ahead with that, and I would be more looking to push for a valuation done by a valuer. I can see valuers are going to have a very, very busy time around here with everyone looking to push a valuation of their asset, business, property, whatever it might be, at 30 June 2027. What would that look like? Well, you can imagine this. If I had an asset worth $0 now, I've got an asset worth $0 now, and at 30 June 2027, it's going to start being indexed, then my gain from now up until that 30 June date is going to be eligible for the 50% discount. Which means the higher my value at 30 June 2027, that's how much of my profit potentially on sale will be eligible for the 50% discount. So if I get a valuation for, say, $1 million for a business, then I at least know from $0 to $1 million, I'm going to get access to the potential 50% discount. Then from after that date, the $1 million will get indexed year on year on year. Now, I'm not saying go out and get inflated valuations because I'm sure they're going to be all over that, but that's just highlighting how that would potentially work. And valuations work on a range because as everyone probably knows here, the value of something is only what the market's willing to pay for it as well. So I can see a situation where people do look to go to the high end of that range. My main comment there would be, I think that's something the ATO would be very aware of. So whatever the valuation ends up being, it needs to be defensible, which is why I say go to a valuer to obtain a valuation. All right. Now, I just want to pause here because I know that was very chunky and very heavy. Checking in, audience, team, questions, comments, thumbs up. Is this landing for everyone? Peace sign, poo emoji. Feel free to just throw it all out there. Yeah. Awesome. Now, the next one on the list is 30% minimum tax on capital gains. So this is a big one. Right now, time to a values course and open kickback. Oh, funny you say that. Did you know Clarico does valuations for allied health clinics? Anyway, shameless plug. The 30% minimum tax on net capital gains. Right now, if you earn zero, this is an extreme example, okay? But if you are someone who earns zero, you don't have any income in your name for whatever reason, and you make you make your first $20,000. I'm rounding up here, okay? So it's $18,000 tax-free threshold, but I'm rounding up here. Your first $20,000 with tax offsets loosely is going to be tax-free. So if you made a capital gain in your name personally and you had zero income, and if that capital gain was 20 grand, it would be tax-free. What this is saying is that, well, hang on a minute, regardless of what your personal tax rate is, we want to tax you 30% on the capital gain. Okay, so you can imagine a $20,000 gain, which was tax-free before, you're paying $6,000 on. All right. Now, once again, I'm using an extreme example, but this is just helping people understand the impact of what this looks like. Obviously, if you were earning more and you're already at a 30% tax rate, this isn't going to impact you at all. What actually really sucks though is the combo of these two. If the 50% discount is gone and taxes are the net gain is taxed at minimum 30%, you could have a situation, and very highly unlikely, I'm very aware of this, but this just helps illustrate the point, is if someone had, or actually, no, this does happen potentially in family groups where you might have a partner, you've got a couple, one partner is doing business, one partner could be stay at home, and that person's the one that invests using the family money potentially, and they make a $40,000 gain across a period of 1 year. So they would be eligible for the 50% discount. How that would look right now, let's just do a bit of a screen share here. So let's look at this example. So we've got a situation where, let's just say scenario 1, scenario 2. Let's just make that a bit bigger. Okay, so this is now and the future, okay? Let's just say there's a situation where someone made a $40,000 capital gain. This is what it looked like now. If they held that for more than 12 months, they're only taxed on half that gain. So they're only paying tax at 20 grand, on 20 grand. If they had no other income, they're basically not paying any tax at all. In the future, what this would look like is the government's going to want to tax. Well, first of all, if they made a profit of 40 grand on the gain, if you held it for a year, indexation, look, unless you're in a really high inflation environment, 3%, for the purpose of the exercise, let's just negate that, it's 3%. But essentially, they're still going to have a $40,000 gain, which they pay tax on, and the government's going to want them to pay minimum 30% on gains, which is going to be $12,000 as opposed to $0. All right. Once again, extreme example, I'm very aware, but I'm just highlighting, hey, this is what it looks like for some people. And I think it's going to be a very small proportion of people that are in that specific scenario. But regardless, it's the combo of these two things which is a bit of a double whammy. If you're in a 30% tax rate or higher, shouldn't impact you much at all. Okay, which is essentially $45,000 and above. So what does this mean for business owners? So this is a big one. If we go back to this screen here, well, that's all well and good for properties, for shares, but when you look at business goodwill, oftentimes people have their business in a company or in a trust, and if you're selling, when they sell, they're selling either the business out of the company or the trust, or the shares out of a company or a trust. So let's actually look at what that looks like one by one. All right, let's look at scenario one. Okay, so let's look at a situation where someone has a company. There we go. That's easier to see for people. So if we look at a situation where someone has a company, okay, a company's tax rate is 25%. All right. So if the companies never got access to the 50% discount in the first place. So if you sold a business, let's just say for $1 million out of a company, the company would pay $250K tax on that. Now, in the future, unless they give any specific concessions to companies, any capital gains made by a company is still going to be 30%, so they're going to be paying $300K. Not a huge difference there. Not as big of an issue. The issue, though, comes when you're in a situation like this. What if you are a company held by a family trust? So your shares are 100% owned by the family trust. One of the most common strategies for people when they sell a business is that they're going to sell the shares. They're going to try and push, the seller's going to try and push for a sale of shares, not a sale out of the business from the company, but a sale of shares to someone, because there are better tax concessions. It's easier to access certain tax concessions. They're called small business capital gains concessions. We can touch on them in a bit later. Under the current rules, if you sold those shares and you held them for more than 12 months, you get the 50% discount. So a $1 million gain, potentially, the family trust is only needing to deal with $500K of income because of the 50% discount. And if There's a few family members that 500k could be split 250k between the two family members, right? And whatever other strategies they want to employ. Okay. So each individual, if they got no other income, they're paying tax on 250. What this would look like moving forward is this. Company owned by family trust. If the shares are sold, $4 million, there's no capital gains discount. Indexation does apply for the purpose of this. I'm just going to move that aside, but there will be indexation. So maybe that $1 million will come down to 900, 850. It depends on how much inflation has happened. If it's at 5% a year, you know, that might come down by a couple of years worth of inflation, but you're not getting that big chunky 50% discount. And then the family trust needs to pay tax because the capital gain has to have minimum 30% tax paid on it. So there will be at least a 300k tax bill, which is a heck of a lot more than individuals paying tax on 250k each. All right. So that's what it looks like if this is your current structure and this is how you sell the business. Now, if you are trading out of a trust instead, so your business is in a trust, this is what it would look like. Right now, if you have a family trust and your business is in here, so you've got a $1 million business in here, and you sell it, same thing, 50% discount, and you distribute to various family members because that's wealth that you had built together, potentially. In the future, very similar situation. The $1 million capital gain will need to be hit at 30% first. So basically what it looks like is under the current rules, the more you're able to use a trust to potentially minimize your tax bill, the worse the situation in the future will be because of that 30% on the 1 million. Now, I just want to clarify, very important here. This is assuming you made that 1 million after 1 July 2027, meaning you generated a lot of that gain after 1 July 2027, right? So if you have generated the majority of your gain up until 30 June 2027, 1 July 2027, you will still be eligible for the 50% discount. So if you were thinking about selling, whether you sell at 30 June or whether you sell at 1 July or a little bit afterwards, I don't think it's going to matter a whole lot. So if you've been worrying that, oh my gosh, I got to do a sale, I was going to sell in 2 years' time and now we're going to pull it forward. No, I don't think you need to worry too much there. I don't think 1 year is going to make that much of a difference unless you're in a situation where your business is going to be worth, I don't know, 100 grand at 30 June 2027, and in a year you manage to blow it up to $1 million or something like that. All right. So for most people, if you already have a business which is established, not in a startup, because startups can experience hypergrowth, it shouldn't impact you unless then you start experiencing more and more growth every year afterwards, after 1 July 2027. Okay. Now, before I go into the trust side, just want to check in with everyone. How's this landing for people? Is there anything you would like me to flesh out a bit more? Was that clear? Yep, all good. Okay, now let's have a look at trusts, because this is an interesting one. So, haven't been for video for growth. I know, right? Yeah. Brad, you're making me tempted to get on my soapbox. I can't. We're already at 47 minutes. Okay. All right, Andy, stay on topic. Trusts. From 1 July 2028. So not 2027. So basically we do have 2 years, well, the 2026 financial year, the 2027 financial year, and the 2028 financial year. So in a way, 3 financial years worth of tax returns or 2 and a bit years in real time until this is a problem, that they're looking to tax trust distributions at 30%. So I will do an example of this, but this second part also plays in. They do say from 1 July 2027. So from 1 July 2028 is when this 30% minimum for trusts is set to kick in. From 1 July 2027 is when they're proposing potential rollover relief for restructures. So a 3-year window to restructure out of discretionary trusts into a company or a fixed trust. A fixed trust is one where people have a fixed entitlement. A unit trust is a type of fixed trust, but it does not all fixed trusts are unit trusts, but the majority of unit trusts would most likely be fixed trusts, which basically means you have a fixed entitlement. It can't change. If you're entitled to 50% of whatever the trust earns, you're entitled to 50%. Very different from a discretionary trust or a family trust where the trustee has discretion on who gets what. Okay. If I just said gibberish to people and they're like, Andy, what language did you just speak? Let me know and I can drop in a video on how a discretionary trust or a family trust works. But I think a lot of the people here, business owners, already know that. But yeah, feel free to drop in and I'll share a link with you on how a family trust works. So it sounds like there will be some sort of rollover relief. They haven't made it clear, is this rollover relief for businesses in discretionary trust or all assets in discretionary trust? Because that is a very important distinction. Currently, there is already rollover relief for businesses in discretionary trusts and assets to an extent. It sounds like they're going to expand on it. But for a lot of people where they have a company owned by a trust, their shares are held by the trust, potentially we would want to see rollover relief for restructuring those shares out of the trust. This is the part where I don't want to speculate what the rollover relief is going to look like. We just don't know. Okay. But let me give a few examples of what this actually looks like in practice. Okay, we are back on the using Excel to draw. I'm normally using Microsoft Paint, so this is an upgrade for me. So let's just say you have a situation. I'm going to ignore a trading company for now. Let's just keep it simple. Let's say you've got a situation. Let me just resize this. All right. Come on, tech. We have a situation where we've got a family trust. And let's just say it earns, I'm going to throw a number out there, $40,000 of profit for that year. Okay. Let's just say this is a corner store fish and chip shop. All right. It's owned in a family trust. And mum and dad, 2 parents live there, work there. As business owners, they probably also live there, right? And they pay themselves last. They don't pay themselves a wage. They're normally working in there, and it makes $40,000. Currently, what would happen is mum would get distributed 20 grand of that 40,000. Dad would be distributed 20 grand of that 40,000. And as we know, with the tax-free thresholds, tax offsets, $18,000 tax-free threshold, I'm rounding up here for any accountants watching and being like, oh, that's not the exact dollar figure to the cents. Calm down. They're going to pay 0 tax, right? Which, in fairness, if you're a business owner, fish and chip shop, you're making 40 grand after that much effort, you probably should pay no tax. What it would look like now, the government wants to tax that bad boy there. Well, not now, sorry. In 1 July 2028, the government wants to tax that bad boy there at 30%. All right. So not a fun time at all. And for those of you who want the exact figure, that's going to be basically 12K tax that they didn't have to pay, right? I'm using a very simplified example here, but this, when I said earlier that I think this hits people who were not intended to be hit a lot harder, this is one of those examples I meant. I don't think this example I'm giving now is as extreme of an example as you may think when you really think about businesses in startup phase early on, businesses which may be established but are bricks and mortar are struggling a fair bit, and a structure which may have worked for them before may not work for them so good anymore and actually could be quite expensive. The government has said that they potentially could have concessions for startups and certain types of businesses, but we just don't know what they look like yet. So I'm only going by what's been announced. Now, for a lot of business owners, let's just say that this isn't your situation, you've got a bit more profit. Well, what does this look like in practice? This is what it would look like in practice. Let's just say you got a trading company. A lot of people do. Trading company is owned by a family trust, right? And you've got, let's just say, I'm just going to go 2 individuals. Nice and simple. If the trading company makes money, it makes profits, it's going to normally pay dividends over to the family trust. So those dividends would have the cash portion and a franking credit attached to it, which is tax on the profits the company has already paid. If franking credits are new to you, please drop a comment. I've got a video teaching you what franking credits are. Essentially, what would happen now is the tax credits and the cash dividend will go to the family trust, and then that would flow through to the beneficiaries. So you'd have a situation where if your beneficiaries of the trust don't really have much other income, they may pay very little tax because the company has already paid tax at 25%. So for these guys, their first 20 grand is essentially tax free. The next 20 grand is taxed at 16-17% plus Medicare. Then there's a good chance they're even receiving refunds. What it would look like now is the company would pay a dividend to the family trust. They've made no mention on what happens to those franking credits, but from everything we're seeing, it looks like those don't get passed on to the beneficiaries anymore, but instead the trust will pay 30% tax on the dividend that it received from the company. The trustee will. It sounds like the trustee will get a credit for the tax already paid by the company. So it's not like it's going to have to pay 30% on top of the tax the company's already paid, which is positive. So basically, it should only just pay a 5% top-up tax. And then the individuals would receive what's called a non-refundable tax offset, meaning they will get the benefit of the 30% tax paid by the family trust, but it's not refundable. So if you only earn 20 grand, you would have had, your tax rate isn't 30%. Your tax rate's bugger all, zero, close to zero. You don't get a refund for the 30% paid by the trust, right? So essentially what that means is people who earn more individually already, this won't really impact them that much. People who earn less or have very little income in their name, they will lose out on the tax already paid by the family trust. They're not going to have to pay tax again. They'll get a credit for it, but any excess doesn't create a refund, unlike a franking credit. So whenever I explain franking credits to people, I always give this example. Hey, imagine a situation. Actually, let's do this. Imagine a situation where a company earns $100 and the company will pay $25 in tax. Therefore, a company will have cash of $75 left. Okay. If that dividend got paid to someone who, let's just say their tax rate is 30%, just I'm rounding off here. If that $75 got paid to someone in a world where franking credits did not exist, that person would then pay tax on the $75 at $22.50, and then that person would be left with $52.50. So that $100 became $52.50. That's an example of when franking credits don't exist and the same dollar has been taxed twice. Okay. That's how I normally explain to people, like, hey, franking credits are good because it means you're not getting taxed twice. You get a credit. This situation now, it's not so much you're getting taxed twice, you just don't get a refund. So I'll give you an example in a world where franking credits does exist. That same individual, where they would get a franking credit, this is what their situation would be. They would get $75 cash, and then they would get a $25 tax credit for the tax the company here has already paid. There's $25 here, which means their total income is going to be $100. Now, we just gave an example that their tax rate is 30%. So they're going to pay tax at 30% of 100, which is $30. Because they receive a franking credit of 25 from above, they get a credit for that 25, which means they only need to pay the top-up tax of $5. That looks great, right? So this is a situation where a world where franking credits exist and someone doesn't get taxed twice. And in this example, this person's tax rate, 30%, is higher than the company tax rate of 25. So all they need to do is pay the top-up 5%. Everyone following there so far? Give us a thumbs up if yes. Great. Now, what if that person's tax rate was lower than 30%? What if it was 16%, 17%? Then they would actually get a refund of $8. Because if they earn $100, they pay tax of 17 cents in the dollar. They got a credit of 25, they'll get a refund for the difference. Yeah, is that making sense to everyone? This is how franking credits work. The non-refundable tax offset basically looks like this. If someone, let's just say someone earns 75 cash and $30 non-refundable tax offset. Okay, I'm doing this live, so this might look a bit janky. Let's go 70-30 because that's a nicer number. What's going to happen is they earn 70, they get a non-refundable tax offset of 30, so their total income's 100. Their tax rate's 17%. Because they got a non-refundable tax offset of 30, that 30 is larger than 17. So technically, 17 minus 30, they shouldn't have to pay any tax. Now, that's going into refund mode there. But the fact that it says non-refundable means that just becomes zero. So they lose out on the extra. Okay, is that landing for everyone there? So, what is the moral of the story there? The moral of the story is if you have a trust and you're distributing to people, I don't think trusts are bad. There's a lot of stuff out there saying, oh, trusts are dead, they're dead forever. I think trusts still have their place because they still give a lot of flexibility. It just means when we distribute using a trust, we have to be very careful because we already showed earlier, if a trust distributes to people with very little income, so below 45K, oh, not 45%, sorry, below 45K. I picked 45K because that's the 30% tax rate. Then they would be in a worse position than now because a trust has paid 30% tax on those distributions and the people have a tax rate lower than 30%, they're losing out on the extra tax that the trust paid. We just have to be very careful. So one of the strategies is if you are that same, let's use that same fish and chip shop example earlier. If you're a same fish and chip shop before, mum and dad working in the fish and chip shop, beforehand when you lived off of a 20K each trust distribution, okay, what that could look like now is instead of doing a 20K each trust distribution, you want to pay a wage out of the family trust of 20K. So instead of doing it as a distribution, you're doing it as a wage. Now, then you might be thinking, Andy, well, what's the point of having a trust then, right? Because you can pay a wage out of any structure type. Well, let's paint an example of what happens when this business here starts making more money. What happens as this business becomes more profitable? What can happen is mum and dad then could potentially pay them both 45K as a wage. So they're both already on the 30% tax rate. And then any other profit from the trust goes out to both of them. Because why does this work? Because even though the trustee may need to pay tax at 30%, that matches their tax rate at 30% that they have already because they already have 45K in their own name from a wage. So nothing's being lost here. So this whole non-refundable tax offset from the trust only creates a negative situation if your tax rate is lower than 30%. Is that landing for everyone? We have a question. Will franking credits distributed to a trust that owns a trading entity still be transferable to individual beneficiaries? Will franking... Hang on, let's draw this out here. So we've got a trust and franking credits distributed to a trust. So I'm guessing, are you saying the fact that you say distributed instead of dividend tells me you're saying from a trust to a trust? Or dividend? Okay, so it's a company pays a dividend. So it's got cash. It's going to have cash plus franking credits. And then goes to individuals. Is this what you mean? So the company pays a dividend to the... Yeah, okay. So this is the situation which I just mentioned is the family trust, the trustee will need to pay tax at 30%. So technically, a trading entity has a 25% effective tax rate. The family trust will need to pay the top up 5%. I don't believe this will need to be clarified once more information comes out. But based on everything we're reading so far, this individual does not get the 30% and the 25% tax credits. That's not how it'll work. That'll defeat the purpose and people will actually be better off if that was the case. We believe that the 25% franking credit will be absorbed by the trust because the trustee will need to pay 30%. The companies pay 25%. There's still going to be a gap there, right? So we believe the trustee will just pay the 5% top up, and then everything left. Then that 30. So the 25% the company's already paid plus the 5% top up equals the 30% that the trustee needs to pay. Okay, and that 30% is what then becomes a non-refundable tax offset. Clear? Cool. Clear as mud, right? So, as I illustrated there are ways to still make trusts viable. We just have to be careful because a wage attracts superannuation, attracts workers' insurance. If you're unlucky enough to employ enough people and create jobs, you get rewarded with payroll tax. So a wage to yourself would still potentially, you need to pay payroll tax on that. So that's where we just need to be careful about how much of a wage people get, and it also has to be commercial, right? If you're getting a wage out of a company, you want that to be commercial and justifiable. All right, so if we got someone who just doesn't work in the company, a wage may be hard to justify. Bucket companies, yes, we can. Okay, so this we're going a bit nerdy here. bucket companies, this is what it would look like. Let me illustrate what bucket companies look like right now. We've got a family trust. We've got a company, trading company. Now, let's just say we have a situation where we've got mum and dad who are on 190K each. So I'm picking 190 because that's the highest marginal tax rate. Every dollar above that, you're pinged at 47 cents a dollar. You may as well just take it to the casino and put it all in red. That's not financial advice. I'm joking there. Please don't do that. But essentially, if mum and dad are already on 190K each, any other profit that comes out of here, if that lands in these people's names and there's no other beneficiaries, you're basically kissing half to the government. You also don't want to leave too much money in a trading company because if anything happens to the business, that money is at risk. So where do you send it? People set up a bucket co. Okay. So the bucket co's tax rate is 30%. It also gets a credit for the 25% the company tax already paid. So basically the bucket co is kind of like what they're making the trust into, which is, but it's going to be worse what they're doing. But the bucket co only needs to pay a 5% top up on every dollar we send over to the bucket co. So essentially, as long as mum and dad are happy on 190 each, they don't need any more money personally. All extra funds can go to the bucket co. And as long as it is not drawn out to use personally, they just pay 5% top-up tax and they can invest using the bucket company. I can see how if you weren't a business owner and you saw that, you were like, that is so unfair. The way this works is that the bucket company is oftentimes used as almost like a secondary super. Imagine if you're like a young person who's actually created quite a successful business for yourself, and and all the sacrifice that came along with it. You would be earning the income that you do, and then you actually want to put some money away. So maybe you are topping up super, but you don't want to wait till 55 to reap the fruits of your labors, right? So a bucket company does act almost like a secondary super because you can access that money sooner. The tax rate isn't as good as super, 15% in super, but it's still a heck of a lot lower than the 47 cents these guys pay. So that's how it works currently. Now, before I show what it would look like under the proposed changes, is this clear for everyone? Yep. Cool. Okay, under the proposed changes, this is what it would look like. Same company pays to family trust. Let's just say mum and dad, 190. You don't want to give them any more money, right? There was very specific wording. The 30% paid by a trust is to non-corporate beneficiaries. Maybe they're going to come out and say, oh, no, corporate beneficiaries will get this other credit. Maybe. But how it's currently written is the family trust pays tax of 30%, the trustee would. If this 30% went to these guys, they get a 30% non-refundable tax offset. But because it says it's only for non-corporate beneficiaries, that means if the money then goes to a bucket company, the bucket company doesn't get the non-refundable tax offset. Meaning, that situation where the example I gave earlier where, hey, this is a world where franking credits did not exist, the situation where the $100 became $55, that situation happens here. If the family trust pays tax of 30% and the bucket company does not get a credit of that 30%, that means the bucket company pays tax again on whatever it receives. Double tax. Terrible. Okay? So that essentially makes a bucket company in this scenario useless. You can't get money into it through a family trust because you're essentially getting pinged double taxed on that money. Now, what does that mean if you already have a bucket company? I don't think current bucket companies are useless up until this is in play. So you do have a few years in play to still work with the law that is currently in place. Because if you currently have a bucket company and you've spent the last few years and the next few years just dumping money in here, potentially the bucket company can still pay dividends out in the future to the family trust with a 30% franking credit. And the trustee, unless any law changes, should get the credit for that 30% franking credit. So the trustee, if the trust tax is 30%, it shouldn't have to pay anything extra. And then the individuals should just receive those funds with a non-refundable tax offset, which means as long as the individuals have income above 45K, they're no worse off. So if you're in a situation where you already have a bucket company, there's funds stashed in the bucket company, you should be able to access those funds in the future again. As long as the individuals have enough income, you shouldn't be in any worse off situation. Okay, so that should give peace of mind to those who already have bucket companies. If you think you're going to be earning a lot of money in the next few years and you want to stash that away, maybe there's an argument for a bucket company, just even for a 2-year use. I got off a tax planning situation where 100 grand in someone's name at 190 and above, they're paying 47 cents in a dollar. In a bucket company that's 30 cents in a dollar, that's a $17,000 tax saving, right? So there is still a time and place if you already have one, and there is still time. It's just that be aware that 1 July, there's a hard stop to this. Now, before I go to the next one, does this make sense to everyone? Please, I know we're getting like very technical here and nerdy. I'm trying not to go too nuanced here. God forbid if an accountant watches this back, they're going to be like, oh, that 0.65% wasn't correct. Yeah, we want to keep this practical for all. So what are some strategies? Well, we want business owners to win. We're business owners as well. Accountants around Australia, the firm owners are business owners as well. So this affects us as well as everyone else, right? There's a few proposed strategies out there, and before I dive into them, I just want to be very clear. Don't just rush out and speak to your accountant and be like, I want to set this up. We don't have enough info, and we won't get enough info for months, potentially. So we can only plan based on the current law that's in place now, which is still your trading company with a family trust shareholder, depending on your structure type and what you're wanting to build, is still the most flexible. And like I pointed out today, trusts aren't dead. You just have to be very careful in how you use them now. They still offer flexibility, but they're going to come with their downsides too, right? So don't go out and restructure, but just keep in mind there are a few solutions here. So there is a situation where a bucket company could still be used. Let's just say you have a situation where you've got a trading co. The business is here, and traditionally, the family trust owns 100% of the shares and the bucket company is out here, right? That's what I just drew out. What it would look like now, potentially, one potential option is the business stays there. You have a bucket company as the 100% shareholder. And then you have the family trust as the 100% shareholder of the bucket company. What does that achieve? Well, you could have a situation where, like I said before, you don't want to keep money in the trading company in case anything happens to it. So the trading company would pay dividends to the bucket company. The bucket company would only pay 5% top-up tax because remember the trading company has a tax rate of 25%. The bucket company has a tax rate of 30%. Then, of the money you want actually access to personally, you just pay whatever you want out of the bucket company through the family trust to the individuals, as long as you honor or you keep in mind that the individuals have at least 45K worth of income. So they're at that 30% tax rate. That's one example where you can still use a bucket company, but the bucket company doesn't sit to the side anymore. It kind of, instead of funds going from trading company to the family trust to the bucket company, they're going to go trading company to the bucket company to the family trust, All right. So in a way, right now, people need to decide how much they want to put to the bucket company. In the future, under this potential structure, people will decide how much they want to pull out of the bucket company because all the funds hit the bucket company first. Is everyone digesting that structure just then? Yep. Now, this is all well and good for people setting up businesses from scratch after all these changes come in place. But what if you already have a situation where you have a company with a family trust shareholder? What do? There is a lot of speculation flying around and ideas people have. There are. So when you have shares in a company, there are things called different classes of shares. Most people have these things called ordinary shares, but you can also have Class A shares, Class B shares, as many classes of shares as you'd like. The thing with shares is everyone who owns a certain class of shares. So let's just say 5 people all. Let's just say 2 people all own ordinary shares. You can't pay a dividend to one person without paying a dividend to the other person because they own 50% each. But if one person owns a Class A share and one person owns a Class B share and one person owns a Class C share, you could pay someone who just owns Class A shares without paying B and C. There are nuances to this, there are downsides to this, and the ATO have in the past come out to say, hey, there are certain setups that they don't like which involve these, so it needs to be done carefully. But that is one strategy that people were saying, hey, could this be a potential solution to family trust to replace them? Maybe. We need to know more from legislation. So that's one solution. So in a situation like this, maybe there's an argument for Class A and Class B to be issued out while the family trust still owns ordinary shares. And maybe a bucket company owns, right? I'm spitballing here live. We don't have enough information. This is one potential solution. But they have said there would be potential concessions to restructure out of this. We just don't know what that includes yet. Does that include shares in a company? Is it just hard assets? Is it just businesses? Because if there are potential restructure provisions, people might restructure from this as a whole. I personally, will I be moving my shares out of the family trust? I don't think so, because like I illustrated tonight, I think there's still a use for a family trust. We just have to be careful with it. There are restructure provisions even now, though, where potentially you could interpose, meaning shove in the bucket company here under current rules. So with that in mind, there is still an option for people who already have their structure set up to do that bucket company situation I illustrated earlier. It just requires way more time planning, and you just want to make sure you're getting it absolutely correct and consult with your tax advisors and your accountants really carefully on this. I don't think we should be doing any changes just yet because we just don't know enough. But it's about having an idea of what's coming on the horizon. And if there was one action point which comes off the back of this for people who, if you're watching this and we don't work together, go to your accountant and just make sure you schedule in. If you have trust in companies, make sure you schedule in July 2027 is when rollover provisions start. I'll be looking at towards the end of almost like next year, around March, when you're doing tax planning March next year for 2027's tax planning. If enough information has been provided about these provisions, plan out, number one, your current structure, how does it hold up on the new rules with how you distribute money and with your income levels? Because I think this is going to be different for everyone, and more bespoke, personalized advice is going to be needed here, right? Number one is, how does your current structure hold up? Number two, is it optimal, or what is the optimal structure for your situation then? And then number three, how do you get from your current structure into that new structure? So it's almost like you're doing a structure workshop again. For those people who are watching this and want to start a business and are like, oh, Does that mean I don't start a business for a few years or be a sole trader for a few years? I also don't think that's the right move, because if you're a sole trader and you've managed to build a really profitable business over the next few years, restructuring that could, sure, there's restructure provisions that get you from a sole trader into a trust really well. But we've just pointed out, a trust still the best move for you. So I wouldn't hold off either on setting up structures that are still applicable now for a few reasons. Number one, companies still have a place. Trusts still have a place. They still just need to be managed carefully. Number two, the government have said there will be some rollover relief. We just don't know what that looks like yet. And number three, there is certain rollover relief already for small types of restructures. So yeah, I wouldn't be letting this hold you back from setting up entities. You just do it knowing we may need to do a bit more surgery later on. All right. So to wrap this all up, we covered heaps here, team. Thank you, everyone. I think everyone's stuck around. So thank you for spending your Monday evening with an accountant. But when I said earlier, this impacts a lot of small businesses. This all comes at a cost of advice, setting up new entities, rollovers, restructures. It's not going to be a cheap exercise. For what? Right? For a situation where we just need keeping up with the government's changing rules. So if we use a fish and chip example earlier, their costs go up significantly. I think these rules hit small business owners the hardest, which is probably the backlash we're all seeing all across social media as well. We covered heaps. There's probably a fair bit more that is worth covering, but I think that's enough for today. Now, before we wrap up, questions, thoughts, comments, please. A one word takeaway from today, or a one-liner takeaway, or any final questions. Feel free to drop into the chat. Is a ladder tax deductible to access to my soapbox? If you charge for your soapbox talks, yeah, very, very potentially. No worries, team. We have a lot to discuss. Yeah. Look, this shouldn't change your tax planning for this year. Won't necessarily change it for next year. Just a few more steps will need to be considered for next year and the year after. All right. So for now, business as usual, team. So hopefully I've given everyone peace of mind. Don't stress out. It's not the end of the world. We can work around it. We just need to wait until more information comes out. And yeah, I think a lot of people's structures are still totally fine, depending on what concessions come out. Thank you, everyone. Have an amazing evening. And reach out if you have any questions at all. Peace.